Financial markets often appear very transparent from the outside. When a stock is bought or sold, that transaction can usually be seen by everyone. Prices, trading volumes, and orders are constantly displayed on market screens. Because of this, many investors believe that all transactions in the market happen openly and are visible to everyone. However, there is another side of the financial world that very few people know about. This is known as dark pool. As the name suggests, dark pools have a somewhat mysterious nature. The transactions that take place in these markets are not immediately visible to everyone, unlike in traditional stock exchanges. For this reason, dark pools are often described as invisible markets. So what exactly is a dark pool? A dark pool is a private trading platform where large investors can execute trades without immediately revealing those transactions to the public market. These platforms are usually created by large banks, financial institutions, or brokerage firms, and they are primarily used by institutional investors. In a normal stock exchange, whenever a trade occurs, it instantly becomes visible in market data. If a large investor places a big buy or sell order, other participants in the market can quickly see that activity. This visibility can sometimes cause strong and rapid price movements. For large investors, this can become a serious problem. Large funds, banks, and institutional investors sometimes execute trades worth millions or even billions of dollars. If transactions of this size are placed directly on the public market, other traders may quickly notice the activity and begin trading in the same direction. This can cause prices to move very quickly, either rising sharply or falling suddenly. For example, imagine that a large investment fund wants to sell millions of dollars worth of shares. If this sale happens instantly in the open market, other traders may see the strong selling pressure and start selling as well. As a result, the price could fall rapidly. This is exactly the kind of situation dark pools were designed to prevent. Through dark pools, large investors can execute their trades in a more controlled way. These transactions are not immediately reflected in public market data, which helps reduce sudden price impacts. For institutional investors, this creates a major advantage because it allows them to manage large positions without destabilizing the market. However, dark pools are sometimes controversial. The main reason for this debate is transparency. Trades executed in dark pools are not as visible as trades on public exchanges. Retail investors usually cannot see these transactions in real time. According to some critics, this lack of visibility may create an information imbalance in the market. On the other hand, many experts argue that dark pools are a natural part of modern financial markets. Very large transactions executed directly on public exchanges can cause extreme price volatility. For this reason, dark pools are often seen as a tool that allows large investors to trade without disrupting the overall market. Today, many major financial institutions and investment banks operate or use dark pool platforms. In fact, some estimates suggest that a significant portion of trading in developed markets takes place through these platforms. Because of this, experienced investors do not analyze markets by looking only at public exchange data. They also try to understand where large market participants might be executing their trades. Because sometimes the price movements we see in the market may be influenced by transactions that are not immediately visible. And one of the places where these hidden transactions occur is the dark pool market.